How do billion-dollar toll roads, bridges, and solar power plants actually get built? When you turn on the lights, drive across a toll bridge, or use high-speed internet, chances are you're benefiting from project finance. In this video, we explain project finance, the hidden engine behind big infrastructure projects. Learn how developers use cash flows, contracts, and smart risk sharing to finance the unthinkable, all without risking their own assets. If you're curious about sustainable energy, infrastructure, or just want to understand how real money moves in the world, this one's for you. Have you ever looked at a massive project and wondered, who actually pays for this? Because it's not the government, it's not Elon Musk, and often it's not even the company building it. The answer? Project finance. It's the invisible engine that makes big infrastructure happen. Let's say you want to build a $500 million solar plant. A bank won't lend you that kind of money just because you ask nicely. Investors don't want to lose their shirts. And you might not even have 1 million. So how does something that big ever get built? Project finance is a way of funding massive, long-term projects by only using the project's future revenues to pay off the loan. Here's how it works. Step 1. You create a company just for this project. That's called a special purpose vehicle, or SPV. Step 2. The SPV signs all the contracts to build the project, sell its product, and operate it. Step 3. Based on those contracts, the SPV raises money from banks and investors. Step 4. If the project works, everyone gets paid. If it fails, the lenders can't come after your company's other assets. That's why it's called non-recourse financing. Here are several real-world examples. The Hornsey Project 1 in the UK, the world's largest offshore wind farm, over £4.2 billion, financed via a consortium of commercial banks, export credit agencies, and equity investors. Improvements for the I-595 corridor roadway in the state of Florida, over $1.6 billion using public-private partnership and project finance. The Carlsbad desalination plant in San Diego, California, a $1 billion project financed via bonds and a 30-year water purchase agreement. The Mozambique LNG project, over $20 billion in project finance commitments from multiple export credit agencies and banks. Even Netflix data centers have been financed this way. If it's big, capital-intensive, and generates stable cash flow, project finance is probably behind it. Why use project finance? Because it's smart. It protects the developer's main business from project risk. It attracts investors who like predictable cash flows. It forces great planning. You have to lock in buyers, contractors, and operators before you build. Think of it like building a house, only having the tenant ready to move in, the construction contract, and even the insurance policy before laying the first brick. Now, let's look at the downside. Substantial upfront money may be required to pay for tons of legal work, engineering studies, and risk assessments. It's slow. It may take years of structuring and negotiation. It only works if the project can reliably generate revenue. That's why you don't see it used for short-term bets. It's built for long-haul infrastructure. So why does this matter to you? Because project finance is how the world builds big things: energy, transport, water, digital infrastructure. It's how private capital steps in where public budgets fall short. And it's a skill set that's in high demand, especially if you want to work in energy, climate tech, infrastructure, or finance. Whether you're an entrepreneur, a student, or just curious, this is a model worth understanding. If this helped you understand project finance just a bit better, hit like, share it, or send it to a friend who's into big ideas. Let us know in the comments if you'd like a more comprehensive video on project finance, or if you want more videos like this, where we break down how money actually works in the real world. See you in the next one.